Computer audio. Share screen. Yes. Okay, so we'll go ahead and get started. I'll admit people as they come through the check-in here. So what we'll look at today is a little bit about exam 3, go over some of the questions that were most frequently missed. Overall scores were super good, so you guys did a really good job on that exam as well. And then once we're through that, we'll start discussion of chapter 14, which is our next to last chapter, and that chapter will be talking about some planning for profit and cost controls. Okay, so get to my other window here. Okay, so this window I've got the questions loaded from the examination. Questions that were missed the most frequently, we had number 5, 7, 10. The 3 that were the most missed were 10, 12, and 13. So we'll absolutely go over those and try to get over all of these here. So chapter, let's see, problem 5. We had Riley Company that borrowed $36,000 on a 1-year note. And the note issued a 1-year, there was a 1-year term and 5% annual interest rate. So the note would be payable both principal and interest in year 2. And that was the hang up with this question. That's what the incorrect answers did not recognize the full year's worth of interest that would be paid in year 2. So that interest would be $36,000 times 5%. So we would have an $1,800 cash outflow from operating activities, plus there was cash revenues of $950, as the problem showed here in year 2. So we would have had $950 inflow, $1,800 outflow for interest, combined was $850 outflow from operating activities. So that's why answer B is our correct response and not answer C. Answer C only takes into effect the accrual of the interest and not the amount that was paid. So that was our problem 5. Question 5. Let's see, 7 was another one that there was a little bit difficulty with. And that was if there's a cash sale of $920 plus 5% sales tax, what would the effect be on the accounting equation? You'd have to recognize or calculate, first of all, how much cash you received on the transaction. And that was, what, $920 of sales revenue times, the easy way is to do, 1 plus the sales tax rate to determine how much cash you would have received. So 1.05. So the cash received from the customers would have been $966,000. So that narrows us down to either A or B. Let me move that out the way. So either A or B. The only difference between A and B is verbiage. Do we have an increase to sales tax expense or an increase to sales tax payable? That's where the trip up happened, and the answer would have been that we're only acting as collecting the sales tax, acting as an agent between the buyer and the State Department of Revenue, whoever is actually going to collect, who is actually going to receive that sales tax. So the cash sale, $920 would be sales revenue. So that much is the same in either B or A. Increase to cash, $966. That's the same for B or A. And the increase is to actually sales tax payable, not an expense. So that makes the answer B and not A. And so answer to 7 there was B. Okay, 10 was one of our problem questions. And that was a bonds question. So we had a company that had $140,000 bond issue. Bonds were issued at 98, so they're issued at 98% of face value. So $140,000 times 98%. Cash received for those bonds would have been $137,200. So subtract the cash received from the actual bond face value, and the discount, 137,200. The discount would have been $2,800 to be amortized over the life of the bonds, which the problem told us was 5 years. So our bonds payable account would be at $140,000. Partnering with that would be a discount on bonds payable that would have a contra-balance of $2,800. And that amount would be decreased at the rate of $560 per year. So the problem asks us what the amount of liabilities shown on the balance sheet would be at the end of year 2. So problem was actually nice and issued the bonds January 1st, year 1, so there's no partial year calculations to happen for year 1's amortization. And year 2, again, another full year. So we're looking at 2 years of amortization on this bond discount. So of that $2,800 of bond discount, we would be decreasing that balance by $1,120. So we had $2,800 in bond discount minus $1,120 amortized. So the balance of that account would be $1,680. And being a discount, that amount reduces the effective balance of the bonds on the balance sheet. So we would have $1,680 plus the $140,000 face value of bonds. So the bonds shown on the balance sheet after discount should be $138,320, which corresponds to letter D. We had a couple answer letter A, and we had a couple answer letter C. And C would have been like no amortization. at all, and A would have been 1 year. Make sure we got nobody else coming in here. Okay, we're good. Okay, so that was 10, one of our problem questions, as was 12. And problem 12, the wrinkle here happens right in the end of the first line, beginning of the second line. Interest was payable in cash December 31st. That is the key to this problem. So we have $680,000 of bonds issued at face value. Interest is paid annually at December 31st. So December 31st, what would be in the statement of cash flows? We have no bond discount or premium to deal with, as the bonds were issued at face value. So at the end of year 1, we would have paid a year's worth of interest, $680,000 times 5.5%. So that comes out to the $37,400 you see given in the solutions. So what the problem was asking us was the income statement. What is it going to show for interest expense? What will the statement of cash flows show from cash outflow from operating activities? And since interest expense is a cash outflow from operating activities, we will show something on that as well. So solution is C, and that is because interest is paid at the end of the year. So we would have had cash outflow of interest at $37,400 and interest expense of the same. We would not have had any interest to accrue, so there would not be any difference between the two. And there wouldn't have been any lapse in payment of interest, because as that end of the first paragraph, or end of the first line, beginning of the second line says, interest was payable in cash December 31st each year. So I think all of our, so that's why the solution is C and not A, because we would have had cash outflow from interest expense per the first and second line of the problem. Okay, so 13 was our biggest problem. It's the one that we had the most issue with. And there's my notes on 13. Okay, so January 1st, year 1, once again, problems being nice and issuing bonds at the beginning of the year. We have a bond issued at a discount. So the bond principal, or the bond face value, was kind of strange, $40,250. Issued at a discounted rate of 98% of face value. So our total proceeds received on that bond issue would be 98% of $40,250, or the amount I calculated here at $39,445. So our discount would be the cash proceeds minus the face value of the bonds. So cash discount was all of $805 to be amortized over a 5-year period. When you have bonds issued at a discount, the amortization of the discount is additional interest expense when the interest payments are made. So that amortization is going to happen over a 5-year period per the problem at the rate of $161. Excuse me. So our interest would be $161 plus whatever interest is going to be actually paid to the bondholders. And that interest payment, and it is paid annually, I'm sorry, $40,250 at the rate of 7%. So again, face value times interest rate gives you interest. They tell you to round the end result to the nearest dollar. So interest would be $2,817.50 plus, that'd be the amount of interest paid. Interest expense would take into account 1/5 of that total bond discount as amortization. So now this is what we round to the nearest dollar. So official answer would be $2,978.50. They tell us round to the nearest dollar. So $2,979 is our actual response. And I think the 2,818 was what the incorrect responses were. And we do interest expense have to take that amortization into account. So that's why the solution is answer B, not answer C. So correct answer is B, 2,979. Sorry. Okay. So really that was the most missed here. 18, pending lawsuit. Per the chapter on Chapter 7 on liabilities, when is a potential lawsuit actually recognized as a liability? You have to meet the criteria of the liability both being reasonably unfavorable outcome. You have to have you're going to lose outcome. And we have a pretty good guess as to what the estimate is. So you have to have reasonably estimated and likelihood of lawsuit high. So likelihood of outcome is probable, can be reasonably estimated. If you meet those criteria, then yes, that's recognized as a liability. Otherwise, disclosure is the way to go. So you have to have both probable and reasonably estimated. Okay, 23 had current assets and including inventory, $14,500. We would only need that if we were calculating a quick ratio. We are not. So current ratio is current assets divided by current liabilities. So we're just going to have current assets, $54,000, divided by current liabilities, $30,000, to give us a current ratio of 1.8. And that is our solution, is answer C. 26, we had number of average days to collect accounts receivable. Going through all the headache of the calculation, we do have to come up with an average. Calculation, let's see, to the right page. It's actually 365 divided by accounts receivable turnover. So accounts receivable turnover needs to be calculated first, which is divided by net credit sales, which is given to us in the paragraph below, divided by average receivables. Well, average receivables are going to be the balance of year 1 receivables plus year 2 divided by 2. So year 1 accounts receivable, 19,000. Add year 2, 21,000. Divide by 2, gives us $20,000 of average receivables. So from that amount, so we'll keep that on memory, $132,000 of credit sales divided by our $20,000 of average accounts receivable. So we turn accounts receivable over an average of 6.6 times per year. I'll do divided by 365, and then I will invert it. So the average days to collect accounts receivable was 365 divided by accounts receivable turnover, which was 6.6. So average days to collect. The typical accounts receivable balance is 55.3 days, and that corresponds to answer C. And then we'll go over one more, which is very last problem, problem 30. Question 30. And question 30 just asked us, and this comes from chapter 9, which analysis procedure will take a key dollar amount in the financial statements and compare all the other elements to that. And that is the definition of vertical analysis. And if you looked on bottom of page 331, the book states that vertical analysis, and I quote, uses percentages to compare individual components of financial statements to a key statement figure. So almost exactly what question 30 is saying. So again, overall scores were extremely good. Results are in the grade book and are all viewable there. If you have any questions, please let me know. So with that, we'll move on to chapter 14, which is our next to last chapter in the text that we cover. And our PowerPoint is as given here. Chapter 14 begins in the towards the back of the book. Actually, our last two chapters are almost in the back. Imagine that. So chapter 14 actually begins technically on page 506. So we're going to be covering here is planning for profit and cost control. So basically budgeting. These last two chapters do deal, excuse me, on the topics of budgeting, just in different approaches. Okay, so the budgeting process, what kind of benefits does it provide? Gives you some predictability, for one. Usually, and it also depends on what kind of time horizon you're looking at. You have budgets set up for different time factors. You might have one budget set established for a short-term planning, like maybe 1 year in length. So your short-term planning, those would look like, look at maybe just, more immediate needs. Do we need a new piece of equipment this year? Do we need to hire more individuals this year? Do we need to lay off people this year? When Bradley closed last year because of coronavirus, that left some budget concerns, and they had to do the finance department would have had to do some short-term planning to determine what they needed to do to go forward. And one thing they needed to do was to initiate a buyout program, and in the hopes of not having to lay people off. And it was actually it was a successful program. And if some were laid off, it was not very many. So intermediate range planning, 3 to 5 years, you might be looking at things more like, your financing at that point, just kind of maintaining. What kind of equipment needs are we going to have in that range? What kind of, personnel requirements? Long range, you might be looking to things more like expansion, looking to get into different product lines. Do we need to, build new buildings, etc.? And all of these are happening at one time, just in different approaches. So there are 3 levels of planning, as noted in the book, in the middle of 508. Excuse me. So you have strategic, capital, and operations budgeting. What each one involves, your strategic planning is looking more at the long term. You're actually developing strategy here. Might involve could involve an examination of product lines. Which of our product lines are profitable? Which ones are not? Do we want to continue those? Do we want to put some marketing into those, unsuccessful product lines and try to make them successful? Or do we want to scrap them entirely? So there would be probably some additional, experts brought in to help the company identify what the most profitable product lines are. And you could have a product line that's a real stinker right now, but maybe it hasn't quite gotten to the point where it is going to be a viable product line. You could be just ahead of the curve technologically. And I'm sure Microsoft was, developing products that didn't really see their full potential until 5 to 10 years after they were initiated. So you don't necessarily want to give up on the product lines which are unprofitable. There's going to be some analysis necessary in order to determine what their full potential is in the future in the marketplace. So capital budgeting, buyer lease is a very typical example of this. In my company, we leased a copy machine about a year back, and I did have to do a little bit of number crunching to determine whether or not it was best for me to buy that piece of equipment, depreciate it, and then have something to trade in towards a future piece of equipment later, or whether to just basically rent the equipment and turn it in when the lease is due. And personally, I went for leasing because in my case, it meant that I didn't have to pay for toner. That was a big part of it. Operations budgeting is short term. That's where we're focusing on basically making budgeted versions of financial statements that we can compare to actual results as those actual results come in. So the key component of the operations budget is what's called the master budget, and we will go over that. So what are your advantages of budgeting? Gives you a little bit of a quote unquote roadmap for the future. So formalizes documents, managerial plans. Of course, there's a lot of meetings which go into budgeting. And that's the second point. Here's the coordination. Budgeting is not just going to involve your accounting personnel. All departments would be brought in on budget meetings so that those departments can vocalize what their needs are for the future and how the company can best fit those needs. Who has the most immediate needs is generally going to be addressed first. And whichever one's going to be in the best interest of the company as a whole. So there'll be, and this is not just a static procedure either. There's budgeting meetings that are ongoing throughout the year. And this is how companies refine their budgets over time. is they keep having possibly even monthly meetings discussing budgeting. Might say, okay, well, we fell short here. What do we need to do? Or why was, the marketing's budget twice what we had planned? So that helps you refine your budget figures in the future and, determine your variances and basically in real time. Another advantage, I just discussed it, performance measurement. Look at your budgeted financial statements, compare it to your actual for the most recent month. We were, $1 million ahead of budgeted net income. That's great. Why? Maybe looking at customer satisfaction. It's low because, we're not responding to our claims fast enough. So there can be, corrective action that needs to be taken due to budget variances. And that's the final point here. So budgeting and analyzing that budget lets you know where you need to make corrective action. For me, if I looked at, my operating expenses and, maybe my cost of paper was too high, I might look at how much I'm wasting in paper and take measures to correct that. So human behavior, of course, upper management, you do have to be sensitive. Employees hear budgets and they kind of freeze up and think, oh no, my job is done. And budgets can be constraining on employees. So you might have a budgeted amount of time to get a certain task performed on the assembly line. So they're constraining. Constraint causes stress. And boy, anytime an employee is brought in as part of the budget process, sometimes it panics. It makes them freak out a little bit. And that is because they might have the impression that, hey, my job is on the line if I'm being brought in to discuss budgets. So what upper management needs to communicate when communicating budget discussions with employees is that what we're trying to do here is, just meet goals. And we're asking you for your input. And that's really the extent of it. And those meetings with employees can be, eye-opening to the employer, because maybe they can realize your management may have set a goal of 300,000 units of product to produce in one day, and in their meetings with the employees they may realize 300,000 is absolutely not possible, so management would have to dial back their expectations a little bit. So meetings, bringing in employees from the various departments can be invaluable when it comes to setting budgets and establishing goals. Okay, so our discussion here on the master budget begins page 510. There's a little bit of a flow chart, which happens right here, 2 slides down. And it shows what information flows into and comes out of the master budget. And the master budget is basically this green right here. So master budget, everything is involved. So there's a lot of smaller budgets which feed into the master. It's a group of detailed budgets and schedules. There is no set format, which is kind of the nice thing with a budget. It's not, there's no adherence to generally accepted accounting principles. So there's nothing that says exactly how a master budget should look. And this is where you get into more of managerial accounting, because that is where managerial accounting really does not have the constraints on appearance of statements as does financial. Because financial statements are generally used not only by internal users, but by external users too. So there are constraints which needs to happen in terms of appearance. Budgeting are generally statements that are used internally. So there is not that constraint as to appearance and as to, what items are included and what items are not. So what a master budget normally includes, it's going to be the entire clump of statements and financial plans. So it's going to have the operating budgets, the capital budgets, and what's called pro forma financial statements. And that would be financial statements based off of budgeted figures, which can then be compared to actual figures as they come in real time. So we're going to do a little example throughout the chapter. A company called Hampton Hams, bit of a tongue twister. They're going to construct a master budget during this chapter. So some of the elements which will be involved will be, the start point is almost always a sales budget. Sales budget will tell us about how many units we expect to sell. That tells us not only how many units we should purchase during the year, but also how many units we might purchase to have as available inventory. That feeds into number 2, the inventory purchases budget. Then thirdly, there's a selling and administrative budget, which sometimes is tied to sales, especially when you have items like commissions involved. And then finally, a cash budget. And each budget is going to be dependent upon an item in one or more of the other sub-budgets. So this is the flow, and this was the little flow chart on the bottom of 510. Light's a little bit light here. Ooh, this is too bright. Light's a little bright here in the room. Okay, so the master budget actually encompasses everything. So our master budget starting point is going to be that sales budget. That is always your starting point. That is going to feed into cash receipts budget and also into the inventory purchases budget. Inventory purchases budget feeds into the cash payments for inventory budget. Those are all elements, the cash receipts, cash payments for inventory, and cash payments for selling and administrative expense are all the items which comprise the cash budget. So then we have our sales, inventory purchases, and selling and administrative budgets. Those are the basis for our pro forma financial statements. And we do an income statement, balance sheet, and statement of cash flows. And the balance sheet would have integrated within it a statement of changes in stockholders' equity. So preparing a sales budget, related to that is a schedule of cash receipts. We need that schedule of cash receipts for our cash receipts budget, which that feeds into then our cash budget in general. So you have to do a little forecasting in order to start the master budget and the sales budget as well. Accuracy's got to be critical. I mean, you can't shoot for the moon and, land on an asteroid 1,000,000 miles away from the moon. You just can't do it. You got to be realistic with your sales budget. So you need the input of the marketing department in order to come up with that sales forecast. So developing our sales forecast for Hampton Hams. They're going to open a new store. Is the whole basis of this project. We're opening a new store. We want to come up with a budget in order to run this new store. So our new store sales, we're opening right about the time of the holiday season. So new store sales expected to be 160,000 in October. We do need to look in terms of the cash receipts budget as to when we're going to receive those sales. They're going to be in the current month or in the month following. So the new store sales, are expected to be 160,000 in October, 40,000 cash, 120,000 account, And those sales are expected to increase 20% per month from October to November and November to December. So sales manager prepares the sales budget that's on the top of 512 and in the next slide as well. Excel is a perfect use for budgeting. So we came up with an October, not only projected sales, but we're working on a schedule of cash receipts as well. It's ideal to have, multiple sections in your budget. Because then, it's killing, two birds with one stone, and so to speak. So our projected sales, we're also building our schedule of cash receipts. Pro forma data, the column for pro forma data, these are figures which will go into our budgeted financial statements. So our total budgeted sales would be our total sales on our income statement, our pro forma income statement. Our total sales on account at the end of December would be our accounts receivable balance on our pro forma balance sheet. So the statement of cash receipts, schedule of cash receipts, we're looking at the cash we received from October, November, December. The assumption is that the accounts receivable balance at the end of one month is collected entirely by the end of the following month, as is the cash receipts from that month. So for October, we would only receive the $40,000 in cash sales. The $120,000 of sales on account would not be received in cash until November. Also in November, Hampton Hams would receive $48,000 of cash sales. So all of this combined, if we added the three together, we might have our schedule of cash receipts, but we're not done with it yet. So we have total budgeted collections, but we have other elements to take into consideration as well. So that's why you don't see any pro forma data happening at the end of section 2. So sales budget is the beginning. Projected sales. Again, we had a 20% increase. So how November's figure was calculated was by taking October's sales and adding a 20% increase on October's sales. So could be as such, could also be shown as if you took $40,000 October sales, times 1 plus the rate of increase, 1.2. Same way to get there. And that'd be a good place to put a formula into Excel. That's what Excel does. So projected sales, and we had the cash sales and the sales on account are assumed to follow suit. That if total sales are going to increase by 20%, the cash sales would increase by 20%, and the sales on account would increase by 20% as well. So you have to make that assumption in order to complete your budgeted, your schedule of cash receipts. Okay, so schedule, it is used later to prepare the cash budget. And the assumptions are we collect cash sales in the month of sale. We collect accounts receivable in full the month following the month of sale. So they gave the example of the October credit sales being received in cash sometime in November. And collections, in reality, collections may never be collected. You may have sales on account that you never collect. That's why we have the allowance for doubtful accounts, eventually bad debt expense. Not everybody pays, but in this instance, we have to assume that everyone's going to pay. So total cash receipts, we will determine by adding that current month's cash sales to the cash collected from the prior month's credit sales. And this all goes back to that Excel spreadsheet right here. So our pro forma financial statement data, again, I mentioned this before, the pro forma data column. This is gathering numbers for the budgeted financial statements, which we will compile basically at the end of the whole procedure. Once we have all of the elements in place, we will compile the budgeted financial statements or the pro forma financial statements. Perfect place for a cell reference. If you're going to do an Excel spreadsheet, you have maybe a tab, another worksheet set up, in, sheets 1, 2, 3, or 4, and you have a space for total, sales revenue. It'd be a perfect place to just hit an equal sign and navigate back to sheet 1, cell E8. And that would be your total budgeted sales for the period. Accounts receivable budget would be on your balance sheet, pro forma balance sheet, as the amount of December credit sales. Okay. And we are preparing a budget for 1 quarter of data. Okay, so with sales budget in place, we can turn to inventory purchases budget and the related schedule of cash payments. There's schedules of cash payments for inventory and there's schedules of cash payments for selling and administrative expenses. Those are dealt with separately. So this starts us at the bottom of 513 in the text. We don't want to just purchase enough inventory to sell. We also need to figure out what is going to be our need for January. We don't want to purchase too much inventory, especially with something like ham, because it might not keep for a very long period of time. Or you're going to have to come up with storage. It's a whole. It gets all confusing. If you buy too much, you have to have a lot of storage, and you might not have as good of a product as if you have more of a just-in-time inventory. And that's where your managers would actually come to the decision of how much inventory do we want to have. Maybe it might be a certain number of days of sales in inventory, but management would come up with that figure through a series of meetings, likely. So we have a a figure called total inventory needed each month. And what Hampton Hams has decided is that their inventory purchased needs to not only cover the month of sale, but also we need an amount on hand. So we will need to purchase again additional inventory. So the computation, and this is the bottom of page 513 in the tan box. Our computation is that we have the cost of budgeted sales plus desired ending inventory equals the total inventory that's needed. From that, we subtract the inventory that Hampton Hams already has on hand. And that will equal the required purchases for the month in question. So for ending inventory for November, that would be, or your beginning inventory for November would be your ending inventory from October. So we will be seeing some relationships there. Okay, so through estimation and through meetings, and this is the paragraph of data underneath the calculation on the bottom of 513. Had meetings, came to the conclusion we want to maintain an ending inventory that's equal to 25% of the next month projected cost of goods sold. So we want to have at least 25% of next month's sales. And cost of goods sold is normally 70% of sales. So we do have a relationship in terms of dollar amount. So since we know our sales figure from the sales budget, we can calculate our cost of goods sold by multiplying that sales figure times 70%. So we have an inventory purchase in Exhibit 14.3, which is the top of page 514. Not only using the information that was just given to us, but that information that was in the sales budget from Exhibit 14.2. So this is our inventory purchases budget. Again, they mention what I just did, that ending inventory for October is November's beginning inventory. Ending inventory for November is December's beginning inventory. So our budgeted cost of goods sold figure, where would that have come from? Our budgeted cost of goods sold was all total projected sales of $160,000 times the figure given, which was 7%. There's our 112. So budgeted cost of goods sold will be for October, would be our total October budgeted sales times 70%. For November would be the total November budgeted sales times 70%, and the same for December. Desired ending inventory is 25% from a couple of slides before of the next month's projected cost of goods sold. So we calculated our cost of goods sold for November at $134,000, which was 70% of November's sales, projected sales of 192,000. So 134 times 25%. Wait, 134.4. Sorry. 25 gives us our desired ending inventory. So $33,600 plus the amount we would have sold in October, and there wouldn't have been any beginning inventory in October because they're just opening this store. So we need $145,600 worth of inventory. No beginning inventory in October. So that is our required purchases. And these are going to be purchases on account. Those will be paid the following month. So that will be part of our cash expenditures. So our pro forma data, what we'll need for our budgeted financial statements, will be our total budgeted cost of goods sold, which is the sum total of budgeted cost of goods sold for October, November, and December. And that would be our budgeted cost of goods sold for our pro forma income statement. Ending inventory would be should be our inventory balance on our pro forma balance sheet at December 31st. So 40%, where that comes from, is that is our cash payments. They got a little bit ahead of all the data here. We pay 60% in the current month of our purchases and 40% in the following month. So purchases on account, December's required purchases on account, 40% will be paid the following month. So that would be accounts payable. So that's where the 40% comes into play. So I just discuss how the budgeted cost of goods sold was figured for October, November, December, as well as desired ending inventory. And our cash payments for inventory are payable at 40%. This actually comes into play on page 514. We weren't given this data before we were given the presentation of the spreadsheet. That cash payments are with our supplier. Like for our October purchases, we will pay 60% of the cost of those purchases in October, 40% of the cost of those purchases in November. And also in November, we'll have payment for 60% of the November purchases as well. So we'll have cash payments for inventory, which will be comprised of payments for more than 1 month worth of purchases. Excuse me. So there is a separate schedule then for cash payments of inventory purchases, which for October, of course, column B would be October, column C would be November, column D is December. That's where we could have had a freeze top rows situation. Okay, so in October, we're paying 40% of the current month's account payable, 60%, I'm sorry, of the current month's account payable. There was no prior accounts payable since the store just opened in October. November, column C, we'll be paying the other 40% of the October purchases, which is this 58,240, plus 60% of the November purchases. And then for December, column D, you're paying 40% of the November purchases plus 60% of the December purchases. 40% of the December purchases at 12/31 would still not be paid, and that is the $62,384 figure. Oops. And that should be 62,384, not 682,384. A little bit of a typo in the book there, in the PowerPoints. So selling and administrative expense budget, a lot easier than these other two. Basically, you're looking at sales commission, supplies expense, utility. And those are the ones that are given. Some of those are going to be tied to sales, some will not. Some might be fixed amounts. So sales commission is tied to total sales revenue. So 2% of total sales revenue. The timing is what we need to take into account here when coming up with the budgeted figures. Sales commission is going to be paid in the month following sale. So our October sales commissions will not be paid till November. So for October, we will have 0 sales commissions. For October, we would have 0 supplies expense because that's also based on, well, actually, no. Supplies expense is paid in the month of sale, not in the month following. So we will have supplies expense. For October, we will not have sales commissions for October. Utilities expense, we would not have for October. That is paid in the month following the usage of the electricity, gas, and water. So what we're given, we would have been given our salaries expense. And this is actually given in the top paragraph under the selling and administrative expense budget header on the middle of page 515. We were given some of these figures as being either fixed items, such as our $24,000 worth of salary expense is a fixed figure. So salaries are fixed at $24,000 per month. Sales commission, we have to do some calculation. Make sure we have nobody else waiting out here. Nope. Okay, good. So we would have to revert back to our sales budget and come up with what the sales commissions would be. So to come up with the actual timing of those cash flows, we determine the amounts first, and that'd be the expense part of the budget. For the cash flow part of the budget, which feeds into the cash budget itself, we would have to determine the timing of all of these expense items. So rent expense will be a constant. Miscellaneous expense will be a constant. Depreciation on store fixtures is also a constant. And we were told the details on the depreciation in page 515. And that is that we had $130,000 of store fixtures with a $10,000 salvage value, depreciated for 10 years. So we would have $12,000 of depreciation expense per year, $1,000 per month. So that is where the $1,000 comes from. Utilities expense is also a calculation. Oh, that was fixed. No. Utilities expense is a fixed amount, but is paid the month following the month of usage. So we have 2 items which are tied to sales, and that's sales commissions and supplies expense at 2% and 1% respectively. The other items on the budget are fixed. But then we do have to look at the timing of these figures, and we were given for our pro forma data, this would be for our income statement for the most part, our expenses. So we would have our salaries expense, salaries expense is not only the total of our 3 months of salaries. We also had some other items happening in here. So sales commissions, utilities expense, depreciation on store fixtures. There would be a payable factor to sales commissions, to utilities expense, and that would be it there. So our salaries expense, $24,000 per month and paid in the month incurred. So the prior month's sales commissions, October sales commissions won't be paid till November. November sales commissions won't be paid till December. December sales commissions won't be paid till the next year. So those will be payable for the balance sheet, the Forma balance sheet. So supplies expense will be 1% of sales incurred in the month of sales. Utilities, there is a lag. So there'll be a payable factor of utilities as well. Rent and miscellaneous are all payable in the month incurred. Okay, so those all lead us to cash budget. Might be, honestly, a good place to kind of put this on hold, in my opinion. So we'll pick up on cash budgets on Thursday. So pick up cash budgets on Thursday. So we'll talk exercises next time, and that'd be 14.4a. And 14.4a is on page 526. And that's preparing sales budgets with some different assumptions. There's 3 different divisions of a given company, of Axon Company. Axon Company, the divisions have different growth rates. So first quarter is given to you, you need to calculate second, third, and fourth quarter. And then that's part A. Part B is to determine the total amount of sales revenue to report on its quarterly pro forma income statements. And that would be all divisions combined for all 4 quarters. So that's 4.4a or 14.4a. 14.8a, schedule of cash payments for inventory purchases. Similar to what we saw earlier. In this case, though, 90% of purchases on account paid within the month purchased. The next 10% are paid the following month. So that was part A. Part B, what is going to be the amount of accounts payable? That's page 527. Also on 527 is inventory purchases and cash payments. So we would have a amount of cash payments budgeted and inventory purchases for July. And then 14.11a in the approximately the middle of page 528. We're given some salaries, some selling and administrative expenses. And they actually do not have anything, I don't believe it's tied to sales figures, but there are timing differences in the payments. As a matter of fact, for example, all expenses requiring cash payments are paid in the month incurred, except for salary expense and insurance. Salary, there is a 1-month lag. Insurance is actually paid in advance. So insurance for 6 months is paid October 1st. So the requirements there are to complete that schedule of cash payments, which is partially given, but fill out the question marks, and to determine the amount of salaries payable and the amount of prepaid insurance. we've definitely gone through enough material to cover that. So we'll discuss those problems, hit the rest of the chapter, go over some more problems. Whoops, I have to fix that. So we'll actually finish up with, oh, wait, I'm on the wrong chapter here. So we'll discuss some more rest of the chapter, go over one more exercise and a problem. We'll assign that on Thursday, and then that'll finish up 14 and we'll go into 15. So any questions, feel free to email me and I will gladly get back with you. And I thank you guys for joining me today, and we will see you on Thursday. I hope you have a good day.